Okay, good morning. We are here to start chapter 11 today, and there is a Learning Catalytics question out there, so we'll get to that in a minute, but it is out there, so log in if you haven't yet. Just going to say a couple words about the final exam. I'll talk more about it at a later class. Final exam is our third exam. It's over chapters 9 through 13, the learning objectives that we cover, so it is not cumulative. It is over the last several chapters. If it runs Monday, May 4th, starting at 9 a.m. through 12:30 on Friday. You have to finish by 12:30. That's when, for my classes, when I look up my sections in the catalog, one section has the final exam Tuesday. So in theory, if you're in those sections, you would need to finish your final exam by Tuesday, but that's just too much of a headache. So everybody needs to be done by the other section. The other section's final exam ends by 12:30 on Friday. So you need to finish the exam by 12:30 Friday. This is not start the exam by 12:30. This is finish by 12:30. So if you started at noon, that's your choice, but you would only have half an hour to do it. The final exam is going to cut off at 12:30 p.m. on Friday, Eastern Time. So whenever you start, it's up to you. If you are in sections 1 or 2, the computer lab, it opens, I have 9 a.m. here because that's the official open time. I believe they will let you start at 8. But you need to plan accordingly. There are thousands of students taking the final exam, taking a final exam or multiple final exams in the computer lab during finals week. We have no way to predict when it's going to be busy. I know there will be busy periods where you might have to wait in line for a couple hours. Hopefully not. Your best chance of not waiting in line for a couple hours is going early in the morning. I have no way to know if there'll be lines Friday or not. Finals week is one of those things that depends when people are getting out of here for other things when they go to take the exam. So no predictions, but we know it'll be busy. If you are in sections 5 or 6, you want to schedule with ProctorU as soon as possible so that you get your choice of times. Again, you need to finish it by 12:30 on Friday, which means I would not schedule after 10 a.m. on Friday. And even if you wait till 10 a.m., you're really risking, because if you have some problem getting connected, you're using up exam time. ProctorU is extremely busy during finals week as well, so the earlier you schedule, the better. You'll get a better time selection. Also, during finals week, ProctorU does take longer to get back to you just because they're swamped as well. Oh, okay. I didn't mean, I guess I'll address that too. I didn't mean to apply. I was speaking to everyone. If you're in sections 1 or 2, you have to go to the computer lab for the exam, the final. If you're in sections 5 or 6, you take it with ProctorU. I was just addressing the issues unique to each of those sections. So you still are going to take your exam in the same location that you have before. I was just talking to both populations. Okay. Caitlin, you need to talk to ProctorU. You need to call them and talk to ProctorU. Okay. Okay. First question: the purchase of treasury stock by a corporation increases total assets and stockholders' equity. So this relates to what we did last week. So talking about treasury stock, let me see just first glance how many we have on here. Okay, 75% are right. So let's see if we can get that closer. Now, treasury stock, when a corporation buys treasury stock, what it's doing is it's going out and it's buying its own stock. So it's taking its cash, giving its cash to whoever's holding its stock, and getting its own stock in return. So it's giving up cash. So when we look at this question, the purchase of treasury stock by a corporation increases total assets. When a corporation pays cash, is that increasing total assets? No, it's decreasing total assets. So this first question, when we look at it, it's false. when a corporation buys its own stock back, it's decreasing total assets because cash is going down, it's spending cash. It's also decreasing stockholders' equity. When it gets treasury stock is a contra stockholders' equity account, okay? And they would both decrease, stockholders' equity and total assets. Okay, so that's it on that one. Then, let's see, on to this question that's going to remain open for a minute or so. It's not going to close on your device. Haley's going to close it at some unannounced future moment in time. Okay, so what's due Saturday? Saturday homework for Chapter 11 is due. The homework's not too bad. We'll do a couple of the problems in class here, and won't be bad. Still need to spend time on it. We're going to do the income statement this chapter. And this chapter, we are not covering every learning objective. We are not covering learning objectives 2 or 3. Okay? So you don't have to read learning objectives 2 or 3 at all. We are doing the other learning objectives. This is not a bad chapter at all. Okay, so we are talking about earnings performance. Up to this point in class, we've gone through the balance sheet. So we start with cash. We had accounts receivable, inventory, property, plant, and equipment. We did liabilities. Last week we did stockholders' equity. So now we're on to income statement. And the income statement really answers the question, how did this company perform? How were its earnings? So when we look at evaluating performance, that's what we're doing with the income statement. So we're going to be looking at the income statement. We're going to be looking at earnings quality, which is one way that investors can evaluate a company. And then the statement of comprehensive income we'll touch on briefly. Okay, so we're going to come back. We're going to go through all 4 of these. So if you don't get it all written down, I'm going to leave this. Okay, there are four ways to components of earnings quality. Okay, so 4 components. I'm going to go through each one of them now. Okay, so 4 components of earnings quality. Let's start with the first one. So the first component of earnings quality is revenue recognition. This isn't a component as much as knowing that the company complies with U.S. GAAP. So U.S. generally accepted accounting principles or international financial reporting standards, but revenue recognition means that the company is recognizing revenue when it's earned. And when it's earned, titles changed hands, and there's a reasonable assurance of collecting the money. So revenue recognition simply means the company's following the rules, and so the revenue it has really earned. So this means if a company collects cash in advance from a customer, that amount goes into liabilities as unearned revenue, not as revenue until the company performs the services. So this is just saying the company is following the rules. And so this isn't anything we measure. This isn't a calculation. This is simply saying the company is following the rules, and that's one component of earnings quality. Earnings quality is something investors look at to evaluate the ongoing, as one component of making a decision to invest or not. To say, how strong is this company? Earnings quality is one component. Are they going to keep earning money? Is their revenue, is their income going to continue to increase? So that's one component of earnings quality. The next component of earnings quality is the cost of goods sold and gross profit. These are listed together because they are interrelated. If you have revenue, you subtract cost of goods sold, you will end up with gross profit. So what we would like to see with companies is that cost of goods sold as a percent of net sales goes down, and that gross margin or gross profit as a percent of sales goes up. At this point, you should know right off the bat that when we talk about gross margin or gross profit, that is net sales minus cost of goods sold. Do you want to type that maybe? Okay. So Gross margin or gross profit, they mean the same thing, is net sales or net revenues. I don't care how you phrase it, but it's revenues minus cost of goods sold. That will be your gross profit or gross margin. Okay. So net sales minus cost of goods sold, that's how we get this gross profit or gross margin. Okay, and we're saying we want cost of goods sold, which is an expense, to go down as a percent of sales, and we want gross margin or gross profit as a percent of sales to go up. Okay, so that's when we look at evaluating earnings quality, does the company have the right trend going? Okay, so those are the two components so far of earnings quality, that the company is using proper revenue recognition, that the gross profit and cost of goods sold trends, and then the next component is operating and other expenses. You want these operating expenses and other expenses to be relatively low compared to sales. Okay, operating and other expenses, these are things like salaries, wages. It's a pretty large category, and we want those to be relatively low compared to sales. But the reason we say relatively low, we don't have a hard, fast line. We're not saying we want to keep cutting them, because cutting costs at some point becomes harmful to the company. You can only cut costs to a certain extent, and then you get to the point where you can't meet your company's mission. So operating expenses, kind of looking for stability there, making sure that the fat's trimmed out, but you can only cut so far. So it's not all cutting costs. Okay, so three components we've done so far. We've done the revenue recognition, the gross profit, cost of goods sold, the operating and other expenses, and the final component, the final thing we look at is operating income. We want to see that improving, and you want to improve operating income relative to sales. That says your earnings quality is going up. And these items that we talked about, sales revenue, cost of goods sold, gross margin, operating expenses, are all interrelated. And we're going to see that in a minute when we go over Amazon. Okay. So what I've got coming up now is an example from Amazon. This is where you get to put down your pencil. I don't want you writing this down because this is just to kind of look at an example of evaluating earnings quality using a real company. So this isn't anything you need to memorize, but I do want to show you this. So what we're going to do is we're going to look at Amazon's earnings quality. This is actually a page in your textbook. I'm using the Amazon statement from the appendix to your textbook. It's Appendix A. This page is 827. So what I've got here is Amazon's consolidated statement of operations. The consolidated means we're adding together all the companies that make up Amazon, that Amazon owns. So Zappos, Amazon owns Zappos, so that's included in here. Any subsidiaries that Amazon has are included here. And statements of operation, that is Amazon's income statement. Okay, so statement of operations is another name for income statement. So what we're going to do now is we're going to look at Amazon's earnings quality. So this is Amazon's statement of operation, their income statement, and the three columns. The first one is 2012, the second one is 2011, and the third one is 2010. So first thing we're going to do is we're going to look at their cost of goods sold to sales ratio. So this is just saying, let's take their cost of goods sold, which is listed on their income statement, divide by their net sales, and we get 0.89. So that is for 2012. We get 0.89. So that's their cost of goods sold, which is an expense as a percent of sales. We do the same thing for 2011, except we move over to the 2011 column. We get 0.89. And then 2010, we get 0.86. So what's happened here is this is cost of goods sold, an expense as a percent of sales. Everything else being equal, we would like to see this ratio go down. We were saying what percent of all our sales is cost of goods sold expense. Well, it was 0.86, then it went up to 0.89, and it stayed at 0.89. So this is not a great thing. This is going in the wrong direction. It's kind of stable, but it's going in the wrong direction. And this is just one component. And what we're doing right now is we are simply assessing Amazon's earnings quality. When we evaluate a company, we look at so much more than just earnings quality. But this is one part of it. So from a standpoint of cost of goods sold to sales ratio, not doing great. Then we look at the gross margin to sales ratio, which should be the exact mirror image of the one we just did, because sales minus cost of goods sold equals gross margin, so these two ratios will be opposite. So the first thing we have to do, a lot of times companies will not have their gross margin listed, so we need to calculate it, and that would be their sales less their cost of sales. And then we divide that by their net sales, and we get 0.11. We do that same thing. That's for 2012. For 2011, it's 0.11, and then 2010, 0.14. This one's moving in the wrong direction, too. Not a surprise because it is mathematically the mirror image of the one we just did. So this one, we're looking at gross margin as a percent of sales. We want this one to be going up. This one's going down, so wrong direction. So then we move on to another one. Operating expenses to sales ratios. Again, we take all their operating expenses, which are everything below their cost of sales. So we add those up, we divide by the net sales, and we get 0.28 for 2012. We get 0.24 for 2011, and we get 0.20 for 2010. So this is our operating expenses. So operating expenses as a percent of sales are going up. So they're going in the wrong direction too. So this doesn't say Amazon has a real strong earnings power, earnings quality. And then the last thing we'll look at is operating income to sales ratio. So we're going to look at the operating income divided by sales, and we get 0.013. 0.0205 and 0.046. Absolutely heading in the wrong direction. We want it to go up, not down. It's been going down. Now Amazon, so when we look at Amazon's earnings quality, we're looking at their income from continuing operations. Not real great. They're not showing up they're not in dire straits. This is not terrible, but this isn't great. Amazon had many, many, many years when it had losses. And investors have been very tolerant of Amazon because they feel it has a lot of things going for it, and it's moving in a lot of directions. Lately, investors have had a little less patience with Amazon because last year, for example, Amazon had a major product flop. The Amazon Fire Phone, which was supposed to be this wonderful phone, and basically you could point to anything and it would order it for you almost. But Amazon, so now they're selling Fire Phones for 99 cents. So they didn't do so hot with that phone, but they've got some other products on the horizon that they're working with. They're getting into one thing I think is exciting with them is they're getting into whole house control kind of. And so that's got some interesting implications, and they're testing drones and things like that. So they have a lot going for it. So this isn't the only thing to evaluate Amazon with, but that's just an example of what investors do. What investors are trying to get to is what's the chances that this company will continue to have earnings that are the same as or better than. And these earnings quality here said kind of weak on the earnings quality, and indeed the last year Amazon missed earnings expectations. So they came in below where everyone thought they were going to be. So that's just Amazon. So that's just why people would look at earnings quality, one way to evaluate earnings quality. So now we're going to do a homework problem, exercise 1115A. And I will say this was a lot of writing, so I'm just going to kind of talk to things. Know that you can always click on the Help Me Solve This, so if you don't get every single thing down, it's okay. What we're going to be doing here is we're going to do a multi-step income statement. a single step income statement says, here's our revenue, here's all our expenses, and here's the income, and we're done. That isn't done in real life. In real life, we do multi-step income statements, which are saying, here's our net sales, here's our cost of goods sold, here's gross margin, let's subtract operating expenses next, and then we get income from continuing operations before tax, and get these long headings. And so in real life, we have multi-step income statements, so that's what we're doing here. So the first requirement is to do a multi-step income statement. Okay, so we'll do that. And then the second requirement is to prepare a statement of comprehensive income. Statement of comprehensive income is a statement that we saw briefly through one example several weeks ago when we were talking about short-term investments. You will not have to prepare a statement of comprehensive income on an exam. You have this little one on your homework, but I want you to know what it is. But if you're an accounting major, you'll get a lot more. You'll be able to prepare one of these. Otherwise, it's basically the oddball statement. It's for everything that doesn't fit anywhere else. So we'll see that. So what we're going to do now, we're going to do requirement 1, and what I'm going to do is I'm going to move this table to the top of the screen and then do the income statement right below it. Okay, so there we go. So every income statement, so we're doing the income statement, every income statement starts with the name of the company, the second line is the name of the statement, and the third line is the date line. For an income statement, this is going to be for the period ending because an income statement measures a period of time. The only statement we have that is one date and time is the balance sheet. The balance sheet says, here's your balance for this date and time. The income statement is for a year, in this case a year. So we're going to start with the net sales. Net sales are always first on the income statement. Okay, next up we're going to subtract total operating expenses. Now, so we'll take operating expenses, and what we're going to do then, notice that operating expenses do not have parentheses around them. Investors and users of financial statements expect expenses to be subtracted. So you have net sales, your expenses, and then your next total is going to be income from continuing operations before income tax to $2,100. So we take the net sales minus the operating expenses to get this income from continuing operations of $2,100. Next up, we're going to subtract income tax expense. And again, we're subtracting it, but we're not putting parentheses around it. You can actually have a negative expense. If this were a negative expense, you'd be adding it back. So don't put parentheses around them because expenses are known to be subtracted. Okay, now I've got a whole bunch of things to talk about now. So basically what we're going to do here okay, so we said that we would take net sales minus operating expenses, and that would give us income from continuing operations before tax. Then we subtract out our income tax, and we get income from continuing operations. So there's a lot of subtitles on this. Now, the next line, income from discontinued operations. This is coming from two different pieces on the income statement, and that's where we're going to focus on now. We get down to below income from continuing operations. We're going to list discontinued operations and extraordinary items. So what we do to get that number is we see we have income from discontinued operations of $320 given to us. But we also are given income tax expense or savings from discontinued operations, just because it's not, I want to pull this. In the problem, it tells us our income tax expense or savings is right here. Okay, so what we're given here. Okay, they're telling us in this table that we made $320,000 from discontinued operations. Discontinued operations are when we sell something. We sell a division. So we sell a division And during this year, before we sold it, we had $320,000 of income from it. We don't want to include that with our regular income because our regular income is income from continuing operations. The reason we make that distinction is when investors are analyzing our earnings quality, we don't want discontinued operations in there because that's not going to continue. Investors, when they're analyzing earnings quality, want to look for things they would expect to reoccur. Discontinued operations, because we've sold it, is not going to happen again. That's why this is shown separately. So it tells us we have $320,000 of income from discontinued operations. Now, we have this income from discontinued operations. We put it on our tax return, and we have to pay tax on it. And they tell us there's where in the left-hand column, it tells us that we're going to pay $94,000 of tax on this $320,000 of income. So what we do on our statement is we show it net of tax. We say, well, we're getting $320,000. We're going to pay $94,000 of income tax. So the net benefit from this discontinued operations is $226,000. Okay? So anything below where we've shown this income tax expense on our statement, so we're right here. Everything under there, if we list special items like this income from discontinued operation and extraordinary item, we have to show the tax effect of those. But we want those things that don't reoccur, that aren't going to happen again, that's why they're down below by themselves. So we show them net of tax. Okay, so that is the income from discontinued operations. We're going to do the same thing with the extraordinary loss. Now the extraordinary loss, okay, extraordinary loss, we have an extraordinary loss of 12. If we put a loss on our taxes, that will save us taxes because that 12 is like another expense. So we have the 12 come off, and that saves us, they told us, $4,000 of tax. So the net impact, the net loss, is only 8 because we had a loss of 12, but that saves us $400 tax, so net loss of 8. This is the one item that we do put parentheses around. The reason we put parentheses around it is because it's a loss. If you see the word loss, if it's a loss, it has to have parentheses around it because that line could be a gain. Okay? We could have extraordinary gain and then it would be added in. But losses need to have parentheses. That's why this one has a parentheses around it. And then we end up with our net income for the period. Okay, so that's a multi-step income statement, and that's requirement 1, where we put together the income statement and we do all these different subtotals as we go. And I think I was missing one line here, one subtotal line. There we go. Okay. So, and again, when you're doing the homework, this problem will not, pretty sure it's not on the final. This would be a really long one to put on the final anyway. But when you're doing the homework, use the Help Me Solve This. This will lay out what you need to do. The next part of this problem was to prepare a statement of comprehensive income. Statement of comprehensive income is we have the name of the company, the name of the statement. Now this is the first time we are officially seeing the statement of comprehensive income. And the statement of comprehensive income, it's for a period of time, and it's saying, here's all the odd things that don't fit on the income statement, that don't belong there. In our case, we have, and it always starts with net income, and then we're going to add a couple things. We're going to add the unrealized gain on investments, currency translation gain, and you get other comprehensive income, and you get comprehensive income. The only takeaway I want you to take from this, first of all, the reason I assigned this is I want you to realize there is this statement of comprehensive income. It includes these things that are not ordinary. So that's where we put the unrealized gains. This is where we put the foreign currency translation gains. And that's all you need to know about the statement of comprehensive income. Again, use the Help Me Solve This. You'll have the statement format, it'll go pretty easily. I'm not going to test you on the statement of comprehensive income, but you at least need to know that it exists. If you're an accounting major, you're going to learn how to do these a lot more in depth than what's shown here. Okay, so what we're going to do now, we're going to do another question. So you've got a question coming out to you. Publicly traded companies have the option to produce audited financial statements. True or false? Okay, key word in this question is option. Okay? Do companies, publicly traded companies, have the option to produce audited financial statements? Okay? Right now, when I look at who's answered or who's the composition, right now it's about split even. Half of you have it right, half have it wrong. So I'm going to try to move the needle over. Okay, so the key word, when we look at this question, publicly traded companies, those are companies that trade their stock to the public, okay? These companies are regulated by the Securities and Exchange Commission, the SEC. The SEC says, okay, here's all the rules you companies need to follow to trade your company, okay, to trade your stock. So we're saying, do they have the option? The option means they have the option to not do this. So let's think about if you have a company that you own a stock in, let's say Kellogg's, okay? So think about it. Let's say Kellogg's has a really bad year, okay? Does Kellogg's have the ability to say, no, you know, it's a bad year, let's skip the financial statements this year? Would that ever happen? No, they are absolutely required. There is no option about this at all. Companies are required to produce financial statements. So let's go with the other word, audited. Okay, an audited financial statement, this is where an outside independent firm comes in. So this is where you hire Deloitte, or you hire Grant Thornton, or you hire Ernst & Young. You hire a CPA firm, they come in, you open up your company to them, you open up all your books, all the detail, all the trail of documentation, and they go through and they look, and they're looking to make sure that this isn't just a house of cards, that you actually have substance, that you've recorded things correctly, that you have processes in place to capture things correctly. And they audit your books. And that is a signal to the investors. This is the investor saying, relying on the auditor. Because if you don't have an auditor in there, then you're just taking the company's word for it. And look at all the scandals where companies try to get away with things even though they're audited. So if companies weren't audited, many, many companies could misrepresent them. So an audit is required. So when we look at this, think about it. Kellogg's absolutely, positively has to issue financial statements. So it is required to issue statements, and it is absolutely required by the SEC to have an audit. Okay, 87% are correct right now. So you're going to have about 10 seconds to fix your answer if you're one of the 13% who are wrong. This answer is false. Companies, publicly traded companies, absolutely positively have to have an audit and have to issue financial statements. They have to do that. The SEC, the Securities and Exchange Commission, requires the audit and the financial statements. Okay. Good, Haley? Okay. Okay. Now, on to our next topic. Okay. Compute earnings per share. One of the most widely quoted numbers for a company is its earnings per share. You can have earnings, companies can say, oh, we made $11 billion, or we made $14 billion, or we made, $200 million. And that doesn't really have a lot of meaning because of the scale. What does that mean? So earnings per share, what the company does is it says, okay, for every common share we have, here's how much we made. So then you can compare earnings per share in one company to another company because it's per share of common stock. So to do this, we have a formula. And this formula is net income minus the preferred dividends divided by the number of common shares outstanding. So this formula, we'll be using it. We're going to have an example coming up here. But what we're trying to do in the numerator is we're saying how much money is earned for the common shareholders. So we have the net income. We're subtracting the preferred dividends out because that's not available to the common shareholder. So we have how much is available to the common shareholders in the numerator, and then the denominator is going to be a weighted average number of common shares outstanding. This says that if you have a beginning of the year, end of year, sometimes you do an average. If a company had a lot of stock outstanding the whole year except for 1 month, they waited. Notice it's outstanding. That means treasury stock is not included. So you don't do earnings per share on the stock of your own that you own. Okay. Now, there's two basic earnings per share calculations. There's one called basic earnings per share. That's what we'll be doing in here. Basic earnings per share is what you hear quoted most of the time. Basic earnings per share is just exactly what that formula says. Okay, next we have diluted earnings per share. And diluted earnings per share are where we say, okay, let's play what if. And what we do with this one is we say, what would the number of shares outstanding be if every single person who held convertible preferred shares converted into common stock? So what we do with diluted earnings per share is we go through a what-if scenario and say, what if all these things happened and we had a lot more common shares? What would our diluted earnings per share be? Sometimes companies don't have any diluted, so it's the same as basic. Again, if you're an accounting major, you will learn how to calculate diluted, fully diluted earnings per share. In ours, we're just doing with the basic, and that's enough. Okay, so illustration. So we have this example we're going to go through right now, and we have a balance sheet that shows three things. It shows preferred stock, and preferred stock, it's $20 par value, 2%, 11,000 shares issued, so it has a total par value of $220,000. Then we have common stock, and we have treasury stock. So we've got three things, and then it tells us we earned net income of $6,200,000, and we're going to compute earnings per share. So first thing we're going to do is we have to calculate two numbers to put in the equation. When we look back at our equation for earnings per share, we have net income minus preferred dividends divided by the weighted average number of common shares outstanding. Okay, so when we're on our example here, we need to calculate our preferred dividend. Our preferred dividend is going to be the par value, $220,000 times 2%, or $4,400. Okay, that's how we'll compute the preferred dividend. That goes back to last week where we took the par value times the percentage gives us the preferred dividend. So what we're doing now is accumulating the numbers we need to calculate the earnings per share. Now the weighted average common shares outstanding, we don't really have to do any weighting here, but we do need to figure out the common shares outstanding. It told us in the problem that we have 1,100,000 shares issued, but we have treasury stock of 120,000 shares. So our outstanding shares are 980,000. So we have the issued minus the bought back, the treasury stock. So the $4,400 is the preferred dividend. The 980,000 is the number of shares outstanding. So then on the next slide, we're going to put those numbers into the equation. Okay, so next, our net income given to us is $6,200,000. Preferred dividends are $4,400. The number of shares was 980,000, and we get $6.32 as our earnings per share. So that's what you're doing for earnings per share. We're going to do a homework problem at the end of class today, or coming up, I guess, where we do earnings per share. Earnings per share is done on every line item, starting with income from continuing operations on down. So it's not just one number, but it's basic earnings per share. When you hear it in the news, they're basically talking about the income figure, but we'll see it in a homework problem that it's actually done on several line items to give shareholders a way to evaluate on a relative basis how big items are. I'll go back to that one. Okay. In terms of where the $6,200,000 come from, that was given in the example, and that net income will be given to you. So in our example facts, okay, right here, it tells us we had net income of $6,200,000. Okay. No problem. Thanks for asking. Okay. 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 So I have another question coming out to you now. And the question is, publicly traded companies have to file their financial statements with the IRS. True or false? Okay, on this one, and I would totally expect this. Right now, 89% of you are wrong on this question. Okay, so let's talk about, let's see if we can move it over. Publicly traded companies have to file their financial statements with the IRS. So let's talk about what financial statements are. Financial statements are the income statement, the balance sheet, the statement of retained earnings, statement of cash flows, those statements along with the disclosures. So these are the financial statements that companies have to, that they create. And financial statements are based on U.S. generally accepted accounting principles or international financial reporting standards, but these financial statements are based on frameworks of accounting that are designed to allow the user to make informed decisions. So the financial statements are prepared using U.S. GAAP or IFRS, and the reason financial statements are prepared is to give investors and creditors a set of information that they can use to evaluate decisions. So the rules behind those statements are designed with disclosure, with public disclosure in mind, and with what makes the most sense, what reflects economic reality the best. Okay, so what is going to help investors make these decisions? What really is the company's true financial position? That's what goes into financial statements. Okay, so then let's go over and talk about the IRS on the other hand. The IRS enforces the tax code. The tax code is developed by legislators to generate revenue for the government. We need a government, we need government services, and we support that through taxes. So the tax code is written to say, here's what you're going to pay us if you do this, do this, do this, do this. So there's a tax code written, it's written by legislators, and every time they make a revision to the tax code, there are people that go through and analyze and say, this is how much revenue this is going to generate for the government. Tax code is a revenue grab. It is designed solely to get money for the government, which I'm not making a commentary on that, but that's its purpose. The tax code is designed to generate revenue for the government. The tax code, your tax return, okay, is not public information. Okay, it's filed with the IRS. So let me see where we are on this, how much we've done. Okay, we're about 50-50 now. Okay, so publicly traded companies have financial statements. Those financial statements are actually filed with the Securities and Exchange Commission. If you go online for any company, you can find their publicly their financial statement because they're publicly traded. It's public knowledge. On the other hand, companies have to file their tax returns with the IRS. A tax return is a completely separate document than completely different. The tax return is filed with the IRS. The financial statements are not. Financial statements are filed with the SEC. The financial statements are publicly available, and they're based on what information investors and creditors need. The tax return is based on what revenue the government wants to generate. It has nothing to do with your disclosures to the public. So the tax return is not public. The tax return uses some information off the financial statements, but it is not designed for public information. So on this one, the tax return is filed with the IRS, not the financial statement. Okay? So we're going to close this question in about 10 seconds. Make sure you have the correct answer. The correct answer is on the screen right now. Okay, so this was false. Okay, next up, we have short exercise 11.3 and 11.9. They're related. On 11.3, it's constructing an income statement. I am not going to go through that right now. It is listed, they're related. So it is listed here, and when you do the homework, click on the Help Me Solve This, and it'll give you the format. I'm just drawing in the subtotals here. The only thing to note on the income tax expense, it says 35%, so you're taking 35% of the income immediately before here. So you're taking 35% of the $40,000 and you get $14,000 and you subtract that to get income from continuing operations. And then your loss on discontinued operations, you need to calculate the income tax savings. So you take the $13,000 times 35%. And then extraordinary gain, same thing. You have to calculate the income tax effect of that. But you'll show those net. So when you have to calculate the income tax expense line, they'll give you the percentage and you do it of the income right above that. Okay, so anyways, I'm not going to do short exercise 11.3, although I wanted to show where it came from. Because what we're going to do is we're going to do the earnings per share. We're doing short exercise 11.9. The two are related. One's an income statement, the other one's calculated earnings per share. So this is a short exercise 11.3 shows on here, and what we're going to be doing is we're going to do the earnings per share. And I said before that earnings per share is not on one number. We do show earnings per share on several numbers, and basically we do our earnings per share calculations on this part of the statement. So we're going to actually do earnings per share on several numbers, and it's going to happen down here. Okay. So what I'm going to do on the next page is I'm going to move that up. You'll see here. Okay, so here's our bottom part of that income statement. Now we're going to do earnings per share. So earnings per share, we're going to start with income from continuing operations. And what we're doing here is we're taking the income that's listed . Okay, income is listed right here on the income statement. So we have that $26,000 in our formula. So we take our net income minus our preferred dividends. That's given to us in the problem as $5,000. So we're subtracting. So we're using that basic formula, and we're divided by the number of shares that we're given in the problem, which is 10,000. So we get $2.10 as our earnings per share for that first line item. So what we're doing is calculating earnings per share on each line item. So income from continuing operations, $2.10. I will also tell you, as I leave each of these items, at the very end of this problem, you'll see all the lines back. So if you miss something on a given line, you're going to see it coming up. Okay, next item, loss on discontinued operations. Loss on discontinued operations, you just take the loss, divide by 10,000 shares. So that's 85 cents, and it's a loss, so we have to put parentheses around it. If it says loss, it takes parentheses. Okay, next up, the income before extraordinary item. Again, any line that has the word income in it, if it says income in the line, we have to subtract the preferred amount. So this line, the first line, and the net income line, you have to subtract that. You don't have to subtract the preferred dividend on the individual items, but just on the income line. So we're going to have the income before extraordinary item, and then I'm just going to put all of this up here. Okay, so what I've got here is the earnings per share of common stock. We're going to take that bottom part of the statement, and we're going to show each item, and the calculations are listed there for you. In case you want to copy it down, I'm going to leave it up. And don't we have a question up next? And Haley's pushing out a question if you prefer to start on the question. So questions coming out. I'm going to be on this for about 30 seconds or so. Okay, I know a lot of you have answered the question already, but I'm going to go to it and display it here. Okay, so which entity requires companies issuing publicly traded stock to have their financial statements audited by an external auditor? So we already established that if you have publicly traded stock, you have to have an audited financial statement. You have to issue audited financial statements. So what agency is that makes you do that? So give it a shot. Get an answer in. Okay, so right now, as of this moment in time, we have 66, about 2/3 of you have the right answer. So what we're going to do is we're going to eliminate some answers. First of all, answer C, Committee of Sponsoring Organizations, has absolutely nothing to do with anything. I don't think we even talk about it. So we can eliminate, it's not C. So anyone that has C as their answer needs to pick another one. Okay. Okay, next up, let's talk about, I'm just going to talk about random answers here. Financial Accounting Standards Board, FASB, answer D. The reason that Financial Accounting Standard Board exists is to create generally accepted accounting principles. So FASB is a bunch of very smart people with respect to accounting, and they get together and through long process create a framework of rules for accounting. So FASB's purpose in life is to create this U.S. GAAP framework. Okay, that's what it does. However, FASB has absolutely zero legal authority. All it can do is say, here's U.S. GAAP, here's U.S. GAAP. It has no legal authority, period. It just creates the framework. So D is not the answer. Okay? So if you've had C or D, it's not C or D. Okay? So not C or D. So then let's talk about the IRS. The IRS, we said the IRS, you file a tax return with the IRS. The government gives the IRS authority to enforce the IRS tax code. That is the scope of the IRS's authority. The IRS cannot require companies to do anything else. The IRS says, here's the tax code. You have to pay the IRS based on the tax code. You have to file a tax return, but that's not the answer either, okay? So the answer is not B, it is not C, it is not D, okay? So answer is not Internal Revenue Service, it is not Committee of Sponsoring Organizations, it is not Financial Accounting Standards Board. Okay, and you have about 15 seconds to choose an answer that's not B, C, or D. So again, the answer is not B, C, or D. Okay. And you have about 10 seconds to get your answer in. In the meantime, what I wanted to do is talk about our plans for Wednesday. Wednesday, we're going to be talking about the last learning objective in the chapter, which is about auditor and management responsibility. They're very different, and management has a lot of responsibility, so we're going to talk about that on Wednesday. I do anticipate, this is with a caveat, I do anticipate Wednesday being a shorter class. Every time, though, I say that, it ends up going long. So, I mean, that's my intention when I go into Wednesday, that maybe it's a shorter class than most. But anyway, so that's what we're doing Wednesday. So we're going to end here, and of course that answer was A, since it wasn't B, C, or D. Yeah. Pardon me? It's on your phone, is it?
No, there were still about like 5 minutes.
Yeah. Okay. Hold that thought for just a second. Class is done. Can you stop recording?